One thing I'll say that you said it's not the first hike that gets you, but we are playing in a little bit of a different time with QE being part of the reason there's so much liquidity out there. How do you think that plays into this, or how you would play it?
Yeah, listen, I think, in some ways, I was alive. I wasn't an investor when Chairman Volcker was around, but, it was very clear reading the history that he was very much focused on one part of the Fed's mandate at that time, which was price stability and breaking the back of inflation. And if that meant weaker jobs for a while, he was willing to accept that. In my opinion, Chairman Powell is on the other end of that spectrum, where he's saying, listen, the most important part of my mandate right now is jobs, and a very broad definition of jobs, what Steve Leisman called U6, which, you want to get the 10 million people that were not in the workforce now, that were in the workforce a year ago. You want to get them back to work. And we're going to not worry about inflation in the interim until we get those folks back to work. I think it's very clear. And I sometimes think with the Fed, there's a tendency, it's white smoke, black smoke. You're trying to, is he blinking Morse code, to tell us something different? I just kind of take the Fed at its word that it's going to remain easy a lot longer than people think. And my own opinion is that people are going to have to get accustomed to meaningfully higher long-term interest rates. And by meaningful, I'm not. It's not what you and Joe were talking about before. I'm saying like 2.5% is not out of the realm of possibility, given the fact that nominal GDP growth this year could easily be 8% or 9%. I just think we have to get more accustomed to higher numbers.
So you like the stock market. You feel comfortable with it, especially given the pullback. But we have seen a much bigger pullback in the NASDAQ than we have in the Dow. There is a bit of a rotation that's taking place into the industrials, into the manufacturing companies, away from the technology companies, and away from those stocks that really soared during the pandemic as we look towards things really opening up. What would you do?
Yeah, it's not the most non-consensus view, but we have a very strong bias towards the value-oriented sectors. So it's financials, industrials, basic materials, and energy. And I think last year, Becky, there were real questions about the fact that there wasn't enough growth. So people were willing to spend almost anything to get secular growers. I think this year, given the amount of stimulus that's coming down the pike, it's very difficult not to get very strong growth. And it's going to be happening in places that are somewhat, for lack of a better term, somewhat more mundane, right? It's going to be happening in banks. It's going to be happening in industrial companies and energy and basic materials. And so that's why I think this is happening. A lot of the tech stocks, some of them, especially the high flyers, you would call them very long duration stocks that have not been discounted by any sort of higher interest rate. And that's starting to happen now. So I wouldn't be short anything because money growth is growing at 26%. But we feel very comfortable being market weight technology and overweight the more cyclical, the more value-oriented parts of the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.